All right. Good evening, everybody. Very happy New Year 2018 to all of you. I hope you had a very fruitful year in 2017 and welcome to the new year in 2018 and spending the first week of the new year attending today's trading webinar on risk management. Just a very quick housekeeping right now is that if you have any issues along the way in the webinar when you cannot hear me clearly or you see a lag in terms of the video or the synchronization, just feel free to press the reconnect button, which is somewhere at the top of your screen, and you should be able to refresh the whole thing and start the continue on the webinar as what I've just left off. All right. So what I'm going to do right now is I'm going to go into a screen share mode to show you the today's presentation slides as I go on to explain to you what risk management is about and how you can go about managing your trades and make sure that you don't really lose a lot of money during your trading. All right. So let me just quickly turn the screen share on. Okay, so all right, so I hope you are able to see my screen right now. So today's webinar is on risk management, all right, the ultimate holy grail to long-term profitable trading. Why do I dare to use this word ultimate holy grail when we're talking about risk management rather than talking about a highly profitable trading strategy? And that is because I personally firmly believe that the only way to have a sustainable and profitable business is, in the first place, you need to learn how to manage risk. In fact, the best traders or the hedge fund managers around the world, one of the key things that they do really well is that they risk manage their positions very well. And that's the reason why you are able to see them making very good returns over many, many years without blowing up their funds or their trading account, while some funds that don't focus on risk management actually blow up their account ultimately. All right, so today's webinar, I'll be covering three main topics, three main things. First is, of course, the 4 typical risk management mistakes that most traders make, and how to better manage your trading risk by sizing your trades correctly. And lastly, I will show a live demonstration to you how to actually plan for a trade with a proper risk management parameters. Okay, so these are just some basic disclaimers. Today's presentation, I will be using some charts of some stocks, but I just want to reaffirm again that I'm not trying to give you tips at all. I'm just using those charts as an example for education purpose, right? So there's quite a number of you who are attending today's webinar for the first time, and just want to quickly share with you the background that I have so that you can understand from what kind of perspective and experience am I sharing all this information with you. So my name, of course, is Philip Teo. And ironically, although I am conducting trading webinars on technical trend trading or technical analysis in nature, I actually started off as a very passionate fundamentalist when I was in undergraduate days. When I started to become interested in the stock market, I actually started off studying very passionately about value investing, fundamental analysis, reading up books from Warren Buffett, Benjamin Graham, and about value investing. And so I was actually very keen to apply my self-learned knowledge of fundamental analysis and value investing after I graduated from a university. And there was this opportunity where I had a chance to actually join an investment research team with OCBC Investment Research. And very interestingly, although I wanted to become an investment analyst focusing on fundamentals, they actually had the opening for the role of a technical analyst. So long story short, I was actually being invited to become a technical analyst in OCBC Investment Research. And initially, I was quite hesitant because I know that my passion is fundamentals, but and they wanted me to try out being a technical analyst, although I know nothing about technical analysis at that point in time. So, but I thought to myself that maybe I should just take up this role so that I have a foot into the investment research team, and who knows, right? Maybe ultimately, subsequently, there could be some fundamental analyst colleagues from the team who leaves, and I might just be able to volunteer myself to my boss and say, "Hi, can I try doing fundamental analysis and value investing rather than technicals?" So it was with that intention that I agreed to take up the job to become a brand new technical analyst with the investment research team, and during the initial 3 to 4 months, my boss actually said that, "Philip, I know you are new to technical analysis. Just take a few months to go and take up courses, study everything about technical analysis, and after that you can start providing technical advisory to our clients. And during that 4 months, I spent a lot of time of my daytime in my job reading close to about 50 books on technical analysis, trading psychology, money management. And I probably looked through like hundreds of charts on a daily basis across Singapore market, Hong Kong market, and India market. And I started to realize that something that pure fundamentalists like myself previously didn't realize about is how important technical analysis is. All right. And that was how I became a very devoted technician thereafter. And ironically, there were many opportunities for me to move into a fundamental role subsequently, because indeed some of my fundamental colleagues left, and my boss even offered me to say, like, Philip, would you want to try out fundamental analysis? And I told her, no, I decided that I want to focus on technical analysis. And that's how I remained a devoted technician in the research team for about 7 years before I left them and become a visionary technologist 2.5 years back, starting TraderWave to build a charting application for retail part-time traders and investors to use. And that's a bit about my background. And so my motivation of starting TraderWave is really to empower everyday people like yourself with like easy to understand trading knowledge, which is the reason why we are conducting a webinar tonight to teach you things about how to easy to follow trading system that you can use so that you can spend the least amount of time possible and still able to find good ideas to trade and follow your discipline and follow the risk management plans so that you can become a proficient and profitable trader in time to come and over a long time. All right. And of course, to provide trading workflow tools like the TraderWave app that we have built so that you can actually become a proficient and profitable traders over the long term. And that's the kind of goals and motivation that we really want to help you achieve. All right. So let's start going straight into today's webinar and what we'll be covering today. So as you know, today's webinar is all about risk management. And this is a topic that many new traders are not interested in, because most new traders, what attracts them usually is how much profit can I make in how much a time, in a short time possible. If you can tell me that I can, if I learn from you and I can make a lot of money in very short time, I'll be very keen to rush in and even to pay a lot of money to learn from you. But the reality is trading is much more than just making profits. All right. For any good traders, before they make a lot of profits, they need to learn how to take risk and protect your capital. So in a way, what is actually trading risk management about? This was a fantastic quote by Larry Hyde, which is a very successful fund manager as well. So in one of his quotes, he actually said before that, I have 2 basic rules about winning in trade as well as in life. If you don't bet, you can't win. If you lose all your chips, you can't bet. So what does he mean by that, in case you don't really understand what he means? Firstly, if you don't bet, you can't win. It means that in life or in trading, you need to make bets. And when you make bets, there's always risk involved, which means that if you don't take risks, you can't really win. Okay, because there's no such thing as free lunch in this world, right? So, but at the same time, if you have to take risks in order to win, there's also another extreme end of the scenario, is that if you take too much risk and you lose all your capital, then you don't even have a chance to take bets anymore. You don't have a chance to initiate trades anymore. All right. And the next time you can bet again is you have to start earning back all your capital by working as an employee or doing something else so that you can build up your capital base again before you can bet. And that is not the most ideal scenario. All right. So that's why the purpose of today's seminar is to teach you how you can actually take risks, make bets, but at the same time, never get into the situation where you might lose all your chips to the point that you can't bet anymore. All right. So we are trying to strike a balance here, and risk management is a very important component. So why is risk management so important? So let's just take a look at this particular example over here. If you have $100 total capital, and if you take too much risk and you lose 60% of your total capital, do you realize how much do you need to make from the balance that you have to break even again back to $100? The answer is 150%. All right, so you to make 150% on the balance of your $40 in order to get back to 100, and that's not even talking about being profitable in the first place, just about breaking even. And what if you have $100 and you lost 80% because you took a big risk on one or few stocks? You lost 80% of it. Do you realize how much you need to make from the balance $20 in order to get back to $100 and break even again? The answer is 400%. So what you will have realized from here is that the more you lose your initial capital, the harder it is for you to break even to original amount again and not even to talk about making profits. All right. So which brings me to my point of I want to show you this chart, which is what we call the risk of ruin. Every trader must see this chart before and learn the implications of this chart. So over here, you will realize that on the left-hand side, the percentage loss of capital. If you lose 10% of your initial capital, you need to make a gain of 11% in order to recover your loss and break even. So if you lose 80%, you need to make 400. And if you lose 90% of your total capital, you need to make 900% from your balance of your capital in order to break even again. So what happens is that it's going to be really, really hard. All right. So now that I've shared with you a basic fundamental understanding of what risk management is about and why risk management is so important, I'm going to share with you what are the 4 typical risk management mistakes that generally new traders or inexperienced traders or traders who just don't learn keep making. All right. So first mistake is a lot of traders that I know that started off don't have a stop loss plan. Okay. So they when they get into a trade, they have no idea at all where is the level that I should get out if I am wrong. What happens is if I'm wrong, what should I do? They have no idea or no concept of that at all. So when they get into a trade, their idea is only that I will want to try to make money. I will try to make money. I will not get out until this position, make money. So that's the reason why if the trade doesn't go according to their plan, they refuse to get out. All right. So what is the problem here when you don't have a stop loss plan? When you don't have a stop loss plan, your rationality will be taken over by emotions. Because why? When you get into a trade expecting it to go higher, but somehow it starts to go lower and you don't have a stop loss, what happens? You start to think that, oh, maybe I should just give this trade a bit more time and then maybe it will recover. And then as it goes lower and lower, you start to feel like, wow, this is not working out, but never mind, just let it be. Let me just become a long-term investor. Although your initial trading horizon is actually short-term or swing trading kind of horizon. Now you become a long-term investor because your rationality has been taken over by emotions. So as such, when you allow your emotions to take over your trading decision because you don't have a stop-loss plan, your human nature, okay, generally will cause you to make all the wrong decisions, right? And the outcome is you will tend to hold on to your losing trades and hope. Remember, it's hope that the trades will return to break even again, which it seldom does. All right. And as a result, there is a huge opportunity cost. Why? Imagine this. If you hold on to a losing trade for 1 year, 2 years, okay, imagine what you could have done if you have gotten out with a stop loss much earlier and you take back the bulk of the capital and put it into another trade, which could have worked out. So you lost you didn't just lose the money that you the paper loss you have in this trade that you are in. At the same time, you are losing the opportunity to use the bulk of your capital to ride the trend of some other stocks that could be going higher from there. So there's a huge opportunity cost to you holding on to your losing trades. All right. So what's my solution? Suggested solution for this is before you enter a trade, please, before you enter a trade or place an order to buy or sell, always decide where you will exit first, okay? And the exit point is a point where you think that when the price goes to the level, that means most likely your analysis is wrong. And that's where you want to get out, recoup back the bulk of your capital with just a small loss, all right? And if possible, you set a stop loss together with your entry order, which means that when you place an order to enter a trade, put in the stop loss together as well, so that the stop loss order will be tagged together with this entry trade, and let the market take you out when you are wrong. All right. So once you have enter a trade and you have a stop loss order inside, if it goes against your analysis, your trading platform will automatically execute the stop loss and take you out of it. All right. So in this way, you don't let your emotions control your decision. You let the market control your decision, and then as a result, you are able to protect the bulk of your capital for other opportunities. Right. The second mistakes that typical traders make is that they risk too much in each trade. So let's just take a look at this problem that a lot of people have. Assuming you risk 10% of your total capital on each in each trade, okay? And what if you have a streak of 5 losing trades in a row? It will mean that straight away you will lose 50% of your total capital. All right, and I've already shown you the risk of ruin. When you lose 50% of your total capital, how much you will have to make to come back? You will need to generate 100% in order to break even again, and it's going to be a very tough climb. So it's going to be very difficult to make a comeback. You really need to be very lucky, or you need to have a very good winning streak in order to do that. So you don't want to get to that level to be down 50% and then have to try to crawl back 100% to break even again. And that's not even talking about making profits at all, right? So the solution is this. Generally, my suggestion is in each trade that you get in, risk just 1 to 2% max of your total capital. Okay, in fact, this is a parameter that many successful traders and hedge fund managers usually suggest as well. All right, so just stick along with me first with this parameter. Later, I will show you exactly how to calculate them. All right. So risk just 1 to 2% of your total capital in each trade, which means that if let's say I get into a trade to buy this stock A, I have an entry price, I have a stop loss price. If let's say I get into the trade and unfortunately the trade didn't work out, it hit my stop loss and I get out, all right, I should not have lost more than 1 or 2% of my entire total capital because of this losing trade. All right. So even if you have a streak of 10 losing trades in a row, which I want to tell you first is you've got to be mentally prepared. Sometimes you are just down on your luck. You might have 10 losing trades in a row. Okay. So when that happens, and if you are just risking 1 to 2% of your total capital, you will realize that you will only lose a maximum of 20%. All right. So if you lose a maximum of 20%, it is still relatively easy for you to get back because you just need to generate 25% from your balanced capital in order to break even again before you have a chance to go into profitability. Right? So that's the reason why the general suggestion is between 1 to 2%. Even the very best traders usually don't risk more than 5% of their total capital in each trade that they get in. Okay, so just remember, stick with me with this parameter first. All right, so in this case, you have a high chance of being able to recover your initial losses, and then you have a chance to go into profitability. All right, so the next mistake, the third mistake that new traders usually make is that they make concentrated and correlated bets in all the trades that they get in. Sometimes it's intentional, but most of the time, actually, when traders make concentrated and correlated bets, it's actually unintentional. So this is the usual problem that I commonly see. Let's say assume that you set a parameter that you will risk 2% of your total capital in each of the 5 different stocks. So let's say you got into 5 open trades and risking 2% of your total capital in every of the stocks. But unknowingly, you might not have really thought through these 5 stocks could be in similar industry. So let's say, for example, if you trade Singapore stocks, you happen to buy OCBC Bank, you buy DBS Bank, you buy UOB Bank, okay, and you buy Hong Leong. So these are all financial stocks, and they tend to be in the same industry. They're either competitors or complementary, and as such, they tend to move in similar patterns. They don't move exactly the same, but they move in similar patterns. So what is the outcome of this? The problem is, in reality, you are actually risking 10% in one single idea, right? Because if they move similarly, your 2% that you risk in every stock will be moving similarly because they move in a similar way. So in reality, you're actually risking 5 stocks times 2% risk each. You're actually risking 10% in one single idea, which means there is a good chance when let's say, for example, this particular industry starts to crumble, you have a high chance of having a big loss because all your positions will all hit your stop loss at the same time. Okay, and that's not what you want to do, right? So instead of making concentrated and correlated bets, the solution is this. Assume you plan to open 5 different new positions, right? Check and ensure that these 5 new trades are generally uncorrelated to each other, so that when you have a losing trades from one particular stock, which is in a different industry, you are limited by the stop loss. And then meanwhile, the other stock, which is in another industry, could potentially be a profitable, and you can ride your winning trades to maximize your returns from there. And as such, there is a much lower chance of you getting a big hit or losing a lot of your capital in one sudden single industry movement. All right. And then mistake 4 that typical new traders make is that randomly deciding the number of shares to buy whenever enter a new trade. And this is what I notice very frequent as well, because usually when I conduct seminars, I will ask the attendees, so when you decide to get into a trade, how do you decide the number of shares to buy? Okay, so a lot of people will say, oh, I don't know, I have $5,000, maybe I just buy $1,000 worth of the stock, right? And that is totally the wrong way to do it, because when you do it that way, you are actually very unsure of the total risk exposure of all your open positions, because you are randomly opening the number of shares. So in any case, you might open too many trades, or you might have a much higher risk exposure than you should, or than what you will feel comfortable with, but you don't realize. All right. So there is also a high chance of significant losses if you do not or is not able to keep track of your total risk exposure, right? So the solution is this: calculate the number of shares to trade based on how much you are willing to risk in each trade. Okay, so I'm going to show you how to do it later, but just follow through with me first. So that's the solution I have for you, so that when you decide on the number of shares to trade based on how much you're willing to risk in each trade, you will always know the risk exposure. That means the percentage risk of your total capital of every position. And as such, if you have let's say a certain fixed number of position, you will know what is the total risk exposure for your entire portfolio of open trades, assuming all of them gone wrong and all of them lose you money. Okay, and as such, you know how much risk have you taken, whether you should actually leverage more so that you can generate more trades, or actually you should stop trading and just let your open position work out itself. Okay, in this way, you will always have control over your total risk that you have. All right, so now I'm going to share with you how you can actually size your trade correctly in order to have a proper risk management. Okay, and whatever that I'm sharing with you right now is actually trading best practices. All right, it's not something that is proprietary from me and taught out by me. No, it's not. All right, in fact, it's a few generations of traders that have been applying these best practices, and many of them were kind enough to share this risk management procedure in terms of sizing the trade. And you will realize that if you are speaking to any very profitable and successful trader, they will all know how to size their trade according to similar methodologies. All right. So how to actually size your trade? Let's just assume that you have done your analysis, be it technical analysis, fundamental analysis, or any analysis, and you decided that, okay, I think that right now, based on my analysis, this stock A is going to go higher from here, and I want to buy this stock A at $1. Okay. So when you make a decision that you want to enter a new trade, firstly, you have to tell yourself, okay, based on the parameters that Philip suggests or the best practices of most traders suggest, for a start, I don't want to risk more than 1% of my total capital on any stock, on any trade. So that's why in this particular trade, I have to make a decision first that I will not risk or lose more than 1% of my capital if I get into this trade and if it goes wrong. All right, so you have to determine that first. Next, you know your entry level, and then you estimate your entry level, and then you determine your stop loss level. All right, so how do you actually determine your stop loss level? That's something that actually I covered in the previous webinar in October or November. All right, so you can go back and take a look at the webinar recording, which I will show you how to do that later on. So I'm not going to dwell into how exactly you should set your stop loss, but generally, stop loss level should be based on a technical price level, that if the price falls to the level, it tells you that your analysis is wrong, and that's where you should get out and cut your loss. All right, so before you actually enter a trade, you need to estimate your entry level and determine your stop loss level first. All right, once you do that, you use the difference between the entry and the stop loss level to calculate the number of shares to buy. All right, and if you do use this method to calculate the number of shares to buy, you will not lose more than 1% of your total capital in this trade or in any other trade that you use the same methodology to calculate the number of shares. So some of you who are new to this might still be very confused. Don't worry, I'm going to show you an example right now how exactly to do it. All right, so let's take a look at this particular example. So let's assume that you have $100,000 of capital. Okay, let's just assume you start with $100,000 capital. So based on the parameters that I suggested to you just now, you can only risk 1% of 100,000. Okay, you're only allowed to risk 1% of $100,000. That means it's equivalent to $1,000 on any trade. Okay, so for this new trade that you want to get in, if you hit your stop loss, you shouldn't lose more than $1,000. Okay, so if it happens that this trade you are looking to enter at $1, and after your analysis you decide that, okay, stop loss, I should place it at 90 cents, because if the price falls from $1 to 90 cents, most likely this stock is going to be going on a downtrend, so I should get out when it touches 90 cents. All right, so you realize that the difference between your entry level and your stop loss level is actually 10 cents. Okay, so you use this 10 cents to determine the number of shares, how many shares, maximum number of shares that you can buy. So you take the $1,000, which is the absolute value of the risk you are willing to take, divided by this $0.1, which is 10 cents, and you will get 10,000 shares as a number of shares, that maximum number of shares that you can buy. So now let's just do a bit of reverse engineering so that you can understand how this whole thing plays out. Huh? So imagine this. So right now, this particular share A or stock A, you buy 10,000 shares of it at $1. So how much have you actually spent? You spent $10,000, right, to buy this, to get into this trade, $10,000. So assuming that the price of this stock falls from $1 to 90 cents and hit your stop loss, and you diligently get out with a stop loss, and how much do you actually get back? You actually get back about $9,000, right? So you see, you spend $10,000 with 10,000 shares to buy this stock, and when you get out at the stop loss at 90 cents, you actually take back $9,000. So in reality, you only lose $1,000, okay, on this trade. And this $1,000 is only 1% of your entire $100,000 capital. All right, so this is the way that you should be sizing the number of shares to buy every trade that you do. Okay, so it might seem like it's like very cumbersome to actually calculate, but actually there's a lot of ways. Some people have used Excel spreadsheet. So this is an example of a previous Excel spreadsheet that I did. So you can actually put in the formulas as per what I have shared with you earlier on, and to just enter all those numbers, you'll be able to determine the size to trade. But I'm going to show you a more easier way later on when I do a live demo to show you how to do the calculation. All right. So now that you have a basic understanding how to size the trade, if you still have any questions on sizing the trades later, please put in your question in the comment, and I will try to answer them to you later on. All right. So now what I'm going to do is I'm going to show you how I actually plan a trade and apply the proper risk management, and how I actually size a trade for it. So that you try to go along with me and try to understand how I actually does it. All right. So, okay. So this is the, I'm using the TraderWave charting application to show you how to go about doing it. All right, so this is an example of Fraser Center Point Limited. Okay, so I'm not going to be dwelling on whether this stock is the right time to get in already or not. Okay, I'm just randomly picking some stocks over here, and let's just assume that we have analyzed the stock and we decided that, okay, I think this stock is going to go higher from here, and we want to make a bet on this stock. So how should we actually decide what's the price to get in, what's the stop loss to do, and how to actually size the trade? Huh? So let's just assume that, okay, based on this simple trend line analysis, it seems like it's still on its way up, and it seems like after the consolidation here, it looks like it's on its way going higher from here. All right, so let's just make the assumption that based on our analysis, we think that there is a good chance that Fraser Center Point will go higher from here. Maybe let's say that there's a good chance it could go to all the way to $2.30. Okay, so based on the usual technical analysis of where to put your stop loss, usually the stop loss you should be putting a certain space away from the immediate support levels. All right, so as you can see over here, it seems like there is the trend line over here, the green line. So when you place a stop loss, if you get into a trade for Fraser Center Point, the stop loss should always be below the uptrend support as well as this immediate horizontal support level, which is where the initial base was over here. Right, so maybe a good place where you can put your stop loss could be anywhere between about 205 or maybe even about 203. Okay, so let's just assume that we decide to set our stop loss at somewhere at around 203. Okay, and our entry level, let's just estimate it to be at the last closing price, which is 212. Okay, so I'm going to show you how, once you decided that, okay, your entry level is here, your stop loss level is where, and your profit taking is where, how do you actually go about sizing your trade? So this is where we actually build a position sizing calculator into the TraderWave app. Okay, you can easily just right click and go to this track your trade feature, where you will open up a window. All right, so our entry, okay, like what I said earlier on, at 2.1. Okay, so stop loss, let's say we decided to put the stop loss at 203. Okay, and our target at 2.3. Okay, so now this is where, and we decide to go long, right, instead of short. Okay, so account size, let's assume we have $100,000. Okay, and the what is the risk that we should be taking? Just now I said, right, parameters generally, if you are a new trader, start off with smaller percentage first. Only when you become proficient and profitable, that's when you risk more. Okay, and I'll explain on another webinar why is it that you need to consider the different parameters and why 1% to 2% is generally the best parameters to start with. All right, so let's just take it at face value right now. Risk just 1%, okay, of your $100,000 in this trade. All right, you realize that automatically here it will calculate for you. Risking 1% of $100,000, you're actually risking $1,000. Okay, and based on the parameters that you enter over here, okay, so you realize, right, if I enter $1.90, you realize the number of shares that you can actually buy becomes lesser. So if based on the stop loss that we have determined, which is at 2.03, you realize the number of shares you can buy is 1111. Okay, and of course, depending on which markets you trade, what's the minimum lot size? In this case, most likely the number of trades you can get is 11,000. Okay, so this is how you actually size your trade accordingly. And you know that if you get into this trade at around 212, if it makes money for you at a target of 2.3, good, you made money. But even if your analysis is wrong and it came and hit your stop loss at 203, you know that you're only losing $1,000. That's assuming, of course, if you get out at your stop loss level. All right. So this is how you can size your trade very easily without needing to type into calculator, and you can just straight away put a tick. And this is how the TraderWave trade tracker feature will actually track where your entry level is, where your stop loss is, and where your target is, and will also show you what is your risk reward ratio. In this case, there's a risk reward to risk ratio of 2:1. Okay, so my suggestion again for parameters and in terms of risk reward ratio, my suggestion is that get into a trade only if the trade shows you at least a 2:1 reward to risk ratio. Okay, again, that's another suggestion that I have for you, which is not related to risk management, but something for you to think about as well. So as you can see in this case, once you do it this way, you know you can buy 11,000 shares of this Fraser center point if you decide to get into it with this stop loss at 203. All right. So in this case, if the price comes and hit 203 and you get out with a stop loss, okay, you will know that you have only lost $1,000. Right. So let me just show you one more example. Let's say, okay, let's take a look at Thai beverage, for example. All right. So as you can see here, generally, Thai beverage has been going up very nicely in this uptrend channel. Okay, and in recent months, it has actually started to go more towards a sideways trading range. Okay, so you will actually notice that there is a support level over here at about 90 cents region. Okay, which happens to be the uptrend support as well. And then the next key resistance is somewhere about 98 cents region. Okay, so let's just assuming you are a range, you have a range trading strategy. Okay, you like to trade stocks that move within range. So this might potentially be a good swing trading, range trading idea, because if you get in the trade over here right now, you think that there is a high probability that it will swing back towards the 98 cents region. Okay, so let's just put the analysis apart and just assume that you think that this is a good trade to get in. And so you want to get in at the last closing price of about 905. And let's say your stop loss, you can potentially put it somewhere around, let's say around 88 cents region. Okay, so which means that if you get in at 90 cents and a half, if the price falls to 88 cents, it means that you have broken both the uptrend line as well as the horizontal support line. Okay, and if it gets to 88, it means that there is a good chance that the price could continue to fall down from here, all right, so maybe if you put your stop loss at 88 cents, that could be one potential or a place for you to put your stop loss. And then profit taking, you could potentially look at 98 cents. All right, so let's just assume that you decided to get into this trade. And how should we actually size the trade to manage your risk? All right, you open the trade tracker tool. So entry is at we want to put it at somewhere 90 cents and a half. So stop loss, we have determined already that we want to put it at 0.8. Okay, and then target, we put it at 0.98. Okay, and as you can see over here, automatically the calculator sizes the trade for you based on your account size of 100,000 and your risk at 1%. Of course, your account size could vary. All right, so my suggestion for you is whenever you want to enter into a new trade, look at your trading platform and see what is the total value of your account size at that point in time. So it could be higher than 100,000 because you have made some profits in other trades, or it could be less than 100,000 because your first few trades were actually losing trades. All right. So maybe let's say your first few trades was losing trades, and you have about $98,000 of your capital left. Okay. So if you reach 1% of your $98,000 dollars balance capital, you realize that your risk value drops from 1,000 to 980. And based on all these parameters and based on your entry and your stop loss, this is the number of shares that you should be buying. Okay, so that's how you actually enter here, and then you just keep track of it from there. And then you enter your trade, and you'll be able to use this to monitor your trade from there. Okay, and so if you take a look at the risk reward parameter, you will realize that there is a 3:1 reward to risk parameter, which might potentially be a good trade to get in as well based on all these parameters. All right. So this is how I've shown you two examples of how you size your trade. So I hope you have a good idea already. So if you have the time, you can just open up a free account in TraderWave app, and then you can try out the position sizing calculator. So I hope that will actually help you. All right. So that's all of my live demo that I'm going to do for you today. So what I'm going to do right now is, let me just get out from this screen. Okay, so I have about 15 minutes time, which where I think that many of you should have a lot of questions that you might want to ask me about risk management, because risk management is not an easy topic to understand for some new traders. So if you have any questions, please feel free to ask me. I'm going in to take a look at what are some of the questions right now. Oh, okay. So one more thing is just now, remember I was sharing with you about that I actually conducted one webinar previously on how to actually determine your stop loss, where to place your stop loss. So for those of you who hasn't gone through that webinar before yet, okay, I also want to share this very good news with all of you right here, is that we have actually recently launched the TraderWave Webinar Hub. Okay, so this Webinar Hub is where we will update you all the information about the webinars that we conduct. Okay, so as you can see over here, we have two segments, which is upcoming as well as on demand. Okay, so upcoming webinars are webinars that we are going to conduct soon in time to come. So as you can see over here, the first upcoming risk is the risk management webinar that we are conducting today. And the next webinar that we'll be conducting live again at 8:30 p.m. Singapore time on the 1st of February is how to become a proficient trader with technical analysis and trading best practices. All right, so in this upcoming webinar in 1st of February, I will be sharing with you 3 typical issues that cause most traders to miss opportunities or get into bad trades. And I will illustrate a few case studies to illustrate to you why it is vital to apply technical analysis together with trading best practices for a good trading outcome. And I will also demonstrate to you what are some of the practical ways to help you turn trading best practices into good trading habits so that you can build a profitable and sustainable trading business over the long run. All right, so if you are keen to register for the upcoming webinar in 1st of February, please go to our webinar hub over here. So you can just go to traderwave.com. Under resources, you will see a webinar hub over here. Okay, just click on it. You will come to this page and you'll be able to register for the upcoming webinars. All right. So for those of you who didn't attend previous webinar, okay, and we also have decided to make it available, okay, to you so that you can come back. Even if you have seen it before, you can come back and recap again. So on demand are those the video recording of the webinars we have done previously. And these are the few webinars that we have done in the previous few months. And if you are interested, you can just go and click on the view webinar recording. Take your time to actually go through and recap some of those topics that we covered in the previous webinar. All right. So I hope this webinar hub will be able to help you have a continuous learning as well as refreshing of the things that you have learned previously. All right. Okay. So right now I'm going to start answering questions that you have for me. And let me just take a look. Okay, so the first question is actually by Yvonne. So my question on risk management is that if I bought Comfort Delgro 1 year ago at $2.70, now it fell to $2, should I still cut loss or should I just hold and take dividend yearly? Okay, so that is a very good question. In fact, this is a question that is totally valid even if it's not Comfort Delgro. It could be any stock that you could be holding on to. So typically many of the new traders I speak to that doesn't understand about risk management, doesn't understand about technical analysis, very often, when I ask them, do you have any open positions right now? They say yes. Okay, so how long have you been having this open position? Or for a few years already. Okay, then I ask them, is there any reason why you're still holding on to this open position? Is it because you're a long-term trader or what? No, it's because it went into a losing trade. I had paper loss on this and I decided not to get out, and hopefully I hope that one day it will come back and break even, then I will decide to get out from there. So there's a lot of scenarios that happen in this manner. So this is a totally very valid question. So when I talk about explain to you the risk management, is based on the new trades that you get in. So what about the old trades that you have got in but you didn't get out because you didn't know about risk management? So I think maybe what will really help is, I think I will just go into Comfort Delgro and just look through the chart itself so that I can give you a complete perspective of how you should approach a losing trade that you have been holding on for a long time. All right. So if we take a look over here, Comfort Delgro. Okay, so right. So obviously, if you already understand technical analysis, you have realized this is a terrible stock to hold over the past 2 to 3 years. Why? Because it has been falling and falling and falling. In fact, if we take a analysis of what happened in the past before, let me just quickly remove all those lines so that we can reanalyze the whole situation again. Okay, so although this might be a Singapore stock, although this might be Comfort Delgro, that's nothing to do with you. Okay, but if you run through with me on this, you realize all the things that I'll be sharing with you can be applied in other stocks that you might be holding on to as well. So as we can see over here, the trend actually, this was where the trend went up very nicely, and then it started to get steeper, okay, before it finally start breaking down over here, come back to test this support and resistance, and start going down from here. Okay, so if you have understand technical analysis, if you have understand stop loss, if you have understand risk management, and you would have gotten out of this stock long time ago. All right, but again, good trading is not meant to have any regrets. Okay, you should not have any regrets about what you do. What's important is you want to learn from the mistakes that you have so that you don't repeat them in the future. Okay, so in this case, you will notice that this stock has been falling. Okay, and it's only starting to get steeper now. The fall is starting to get steeper. Okay, so the point is, has it shown any signs of turning around yet? Okay, so let's say if you had put in a $10,000 into Comfort Delgro when it was, let's just assume that when it was $3. Okay, after it has fallen to about 175 or 150 to make it easy, you have already lost $5,000, half of your capital. Okay, half of the position you have on this stock, you already lost half of it. So if you sell out now, you can get back $5,000. Okay, so you might think that, well, if I get out now, I lose the $5,000, the paper loss. Right now, I'm actually realizing that loss. But think about it another way. If you get back your $5,000, you could use this $5,000 to get into another trade that looks like it's on its way up. Okay, so which means that you get back this $5,000, you get into a stock that is on its way up. What happens is that, let's say 2-3 months later, the other stock that you put this balance of a $5,000 in, it goes from $1 to $2. You would have double your $5,000 back to a $10,000. But if you still hold on to the current $5,000 in the Comfort Delgro and we continue to go lower from here, you are still losing money. Or even if it goes sideways, you are not going to break even, but you are still not going better either. Although you might not be losing, but it's not getting better either. So you realize what's the thing that I'm trying to share with you over here is the concept of opportunity loss. Okay, so if you continue to stick with a stock that is not showing signs of turning around yet, you are losing the opportunity to take back the initial amount of capital and put it into another stock that looks more likely to be going higher straight away from where it is currently at. You get what I'm trying to say? Okay, so that's the opportunity cost you need to consider. At the same time, psychologically, my suggestion usually is also that if you have a loss that you didn't get out earlier, but you think that it is sometimes it's good that you just get out of a losing trade so that you can readjust your own psychology again. Okay, go back to a clean slate again. You don't have a baggage or a burden that is still resting on your shoulder. Okay, you can start fresh again with whatever amount of capital you have left over with, and then look at trades in a different light again. Okay, so get all the bad baggages out by getting out of this stock. Okay, and especially the stock has not shown any signs of really recovering yet. Okay, so get rid of the baggage while it's not recovering yet, and then focuses on doing the right things, applying the best practices, and applying all the best risk management practices that I shared with you earlier on just now. So that's my suggestion. If you are looking at ComfortDelGro, you got in earlier, now it has lost this amount of money, what should you do about it? Okay, these are my suggestion for you. And again, the decision has to lie with yourself, Yvonne, and you have to take responsibility of what you want to do with it. Do you want to have a clean slate and start all over again by getting out of this position, or do you still want to hold on to this baggage and let it affect the rest of the other new trades that you want to do by applying the best practices in them? Okay, so the decision lies with you, right? So let me go back to the questions. Okay, so can you show the position slides in a text format, the slide before the Excel spreadsheet? Okay, so maybe I'll try to show that later on, or otherwise you can actually watch the video recording, because we should be sharing the sending you the link to the immediate video recording tomorrow, and then you can try to go back to that point, and then you take a look at the slide again. So I'll just try to answer questions that is more helpful while I'm still here live over here. Okay, so how do you handle a losing streak? Okay, the way to handle a losing streak is this: be mentally prepared for a losing streak. Okay, every good traders, they are always mentally prepared that they might have a losing streak. And losing streak doesn't mean that it's a problem with your strategy sometimes. Okay, sometimes losing streak happens just because your strategy is not working out for that period of time and you have losing streak. That's why it's so important to contain your losses in every trade, so that when you have a losing trade, you don't actually lose so much of a capital that it will psychologically affect you and make you very fearful of taking new position. Okay, as well as it is easier for you to recover the losses that you make in your losing streak. Okay, so losing streak really is about handling it psychologically by, firstly, be mentally prepared that you will have a losing streak. If your losing streak doesn't come now, it will come later. Always be mentally prepared for it. Okay, and make sure you size every of your trade conservatively, so that even when a losing streak comes, it will not kill off a big part of your capital base. Okay, that's how I would suggest you handle a losing streak. All right, and from DJ, hi Philip, if you trench buy or pyramid trade, do you adjust your buy to fit the 1% of your risk? Okay, that is a very good question. Actually, before I prepared the slides for today's webinar, I was thinking about whether to cover this topic or not, but I realized that maybe I shouldn't, because many of you are actually new traders, and a pyramiding concept or adding on to your position is something that would most probably confuse you more. But just to answer DJ's questions, if you tranche buy or pyramid trade, do you adjust your buy to fit that 1% of your risk? Yes. Okay, so my suggestion is this: if let's say you decide to get into a trade and you decide that your parameter is that I don't want to lose more than 1% in every trade. Okay, so the trade, when I mean the trade here, I'm talking about that particular instrument. Okay, if you pyramid 3 times into this trade, it is still considered as one trade, in my personal opinion. Okay, you are just getting into the position in 3 different trenches. Okay, but it's still one single trade, and that's the case if you should just risk 1% of your total capital on this particular trade. So if you decide to trench buy or pyramid 3 times, which I will not explain the rationale of doing that. Since you asked this question, I'm sure you understand the rationale of doing a tranche buying or pyramid trade. But in order not to confuse the rest, I'm not going to explain why a more experienced trader like to do tranche buy or pyramid trade. Okay, but I'm just saying that if you decide to tranche buy, my suggestion is to break up your tranches into 0.33%, 0.33%, 0.33%. Okay, so in this way, when you trench buy, and if it works out for you and you manage to get into all the 3 trenches because it's working correctly, then you are actually risking a 1% total in this particular trade. But if let's say you get into the first trench with 0.33% and straight away it didn't work out, okay, then you only lose about 0.33% instead of losing the 1%. All right, so I hope I answered that particular question for you. All right, and next from Sabra. Do you have a course for beginners? How can I start trading from India? Do you conduct seminar in India? I'm so sorry, I don't actually conduct seminar in India. And that is actually the reason why I decided to conduct webinar, so that whatever I have to share about my knowledge and experience can reach out to people like yourself who is based in India. Okay, but actually I was in India in February last year, for those of you who might not know. So I actually conducted 3 hours basic introductory free seminar when I was in Bangalore, Mumbai, as well as Pune. All right. So because I was there for a short time, I could only do a short 3 hours free seminar. But I'm most likely I'm not having immediate plans to go to India to conduct seminars over there. So the only way I can help you is continue to attend the webinar that we will be consistently be conducting on a monthly basis. Okay, and I hope you can learn as much as possible from the webinars. And if you happen to come into Singapore, I actually do conduct seminars together with SGX. Okay, that's a 2-day course. Okay, so if you come to Singapore, maybe you can try to meet your time around that. But other than that, unfortunately at this point in time, I can't really go to India to conduct courses or seminars for you over there. All right. And okay, next question. Okay, from Qin. What is your technical analysis you are using to think that the target price is a high chance of the price of the stock will go up to that target level? Okay, so just now I show you 2 different trades, right? One is you are trying to swing trade from an uptrend of a stock. The other one is trying to make a bet that the current stock's coming to a key horizontal support level. There's a good chance it will bounce off to the top horizontal trading range at the resistance level over there. Okay, so these are actually slightly different methodology or strategy. Okay, so again, my philosophy is this: I've never ever believed that there is a one-size strategy that fits everybody. All right, so everyone who is a new trader would have to study and understand how a few different types of strategy works, and then you make a decision which strategy sounds more logical to me. Okay, then you start with applying that particular strategy, and then apply it for a series of trades, at least about 10 to 20 to even 30 trades. Okay, then you will see your personality and your character coming into potential conflicts or synergy with this strategy that you're using. That's when you start to learn about yourself as a trader, whether this strategy is something that fits your personality or is it something that conflicts with you. If you constantly use this strategy and you face a lot of conflicts in terms of taking the trade, then maybe this strategy is not the right kind of strategy for you. Okay, so some people are more suited to do longer term trend following strategy. Some people are more suited to do short term swing trading strategy. Some people, their personality is more suitable for doing a range trading strategy. That means you just try to trade within the price range, a certain price range. So there is no one single technical analysis way to decide what's the target price until you know what is the strategy that you want to do. Okay, and a lot of all these strategies, actually, if you Google around, you will realize that a lot of very nice people actually do share a lot of strategies out there. Okay, and again, you won't know whether the strategy is working out for you until you actually try it. Because a strategy that works for me might work for me because I'm actually trading just Indian stocks. Okay, but if you apply it in Singapore stock, maybe Singapore stock market has a different kind of characteristic in terms of how the price move. Okay, and it might not, that strategy might not work as well in Singapore stocks. So there's a lot of different factors which you have to try and error. There's no two way about it, because I still believe there's no one single strategy that is the best for everybody. And in fact, if there is one strategy that is so highly profitable and everybody use that exact strategy on the exact stock, usually the edge will disappear thereafter. Okay, so what is your opinion on SIA Engineering? Okay, it is at around 5-year low. Okay, so I'll list this to the later part because the main focus of my webinar is not to offer advisory on the stocks. Okay, so I will just focus on answering all those questions that is more about the risk management and about the today's topic first. And if I have time later, maybe we'll just go back and take a look at SIA Engineering again. All right, so now the next question is from Rigi. Okay, so when cutting loss, do you fully close the position or do you partially close at multiple stop loss level? My suggestion is set a stop loss level that is comfortably away enough from the support level, and then if it touches there, just get out. Okay, especially if you are a new trader. Okay, if you are a new trader, it is psychologically very difficult to handle multiple tranches of entry and also to handle multiple tranches of stop losses. Okay, so my suggestion is determine a stop loss, make sure it is comfortable away enough from the support level so that the volatility will not cause it to hit that stop loss level on an intraday basis. And once it touches that level, close off, have a conclusion to this trade so that you can move on to the next better trade. If you're constantly thinking about, how should I size out of the losing trades, or I should size in of the winning trades, for a new trader, it is too much to handle, really, really. So just focus on one entry point, one stop loss point, one profit target level. Keep on doing this until you feel very comfortable with the entire process. That's when you start to look at ways to optimize your profit taking or your entry level and optimize your stop loss getting out level. All right. So my suggestion again is, for a new trader, generally inexperienced, just stick to one stop loss level. Okay. And just stick to it. Okay. So next question from Subra. Okay. Is it possible to open trading account from India without visiting Singapore? Okay, that's a question that is totally not related to risk management, or unless you're asking this question because you want to risk manage your capital by having it in Singapore rather than in India. I hope that's not the perspective you're looking at. But based on what I understand, yes, it's totally possible to open a trading account from India without visiting Singapore. I think that's unlikely. You need to come to Singapore to open a trading account because you need to physically show your presence and show your documents so that they can do a know your customer procedure and ensure that you are really the person who's opening up the account and putting the money in. Yeah, so unfortunately, I think you have to visit Singapore in order to open a trading account. All right, so one last question on the SIA engineering. Okay, so we have just a few minutes more, so I might as well answer the final question. Opinion on SIA engineering is at a 5-year low. Okay, so if you just take a look, for those of you who has no vested interest in SIA engineering, this might be a good chance for you just to study the way how I look at the chart, and maybe it will help you when you look at other similar charts going forward. Okay, so this is SIA engineering. Definitely doesn't look good for a long time already. So as we can see over here, if we zoom out to the maximum from 2007 until 2018, that's about 10 years history. We will have seen that during the subprime, it actually fall this much, recovered all the way to a new, I believe is all-time high of above $5. After that, do you realize it actually start to consolidate sideways? Okay, so some of you might think, hey, is this a triple top or quarter top, because it's just like fall over here? But what's important is we see this key resistance turn support level, okay, being broken. After that, it starts to go lower from here. Okay, so as it has been falling and in fact recently has accelerated its fall. So right now it is at a new it has just reached a new 52 weeks low at about 301 region. Okay, so logically, if you just look at it, does it looks like it's on its way? Oh, sorry, so you can't see the chart. Okay, so I'm so sorry if you're just listening me talking without seeing the chart, because I didn't realize that I have not actually shared the screen. All right, so if we just come back to the chart again, okay, as you can see over here, the fall, the rise, the consolidation, and then the break and the fall thereafter. So right now, the stock is over here. This is actually a very difficult stock to trade, or even a stock to invest in is very difficult because the trend lines and stuff isn't very, very clear cut. So usually I tend to avoid even getting into trades like this because I can't seem to be able to analyze it with a good probability. And it's very hard to determine where is going to go right now. So the only thing that we can see over here is that very clearly 334 was previously a very strong support level. And after it was broken on very high trading volume, okay, the next time it came back to here, it failed the test and comes to here. Okay, so generally from what we can see over here, the probability is still more towards it going sideways or falling further from here. Okay, it is definitely not showing any clear signs that is on its way up and going to have any signs of showing a strong recovery yet. Okay, so to answer your questions, okay, your opinion, my opinion on SIA engineering is a new 5-year low. Yes, my opinion is that it has just reached a new 5-year low and it has filled a very key support turn resistance previously, just 1 to 2 months back. So anytime it comes back to 334 again, it is going to be a very strong resistance and it will be very hard to overcome. That's the reason why the probability of it going higher all the way to 350, 375 or $4, the probability is not actually very high. Okay, and if it ever happens and it comes to $4, I think it's going to take a significantly long time from here. All right, so again, think if you already have position in this stock, think about your opportunity cost. If you continue to hold it while it is still not showing any signs of recovery at all. All right, so thanks. I think this time is about just nice. It's about 9:35 in Singapore right now. And okay, there's one more question over here. Any specific webinar on the most popular candlestick pattern? To put it very simply, candlesticks, candlestick is actually something that I believe and I have seen before. It's very easy to find online. So if you actually just Google about candlesticks, you will see that there's a lot of articles, and even if you search on video, there's a lot of videos that teach you how to identify candlesticks. All right, so candlesticks, the way of identifying candlestick patterns is very straightforward already. So a lot of resources there, but what's even more important is not blindly following candlestick patterns. Okay, it's about understanding the psychology, why a certain candlestick pattern happens, and try to understand what is the participants of this particular stock thinking when this candlestick pattern emerge. Okay, so that you can make a better, more informed decisions from there. So I might look into conducting candlestick webinars maybe in time to come, and also to explain how you can put candlesticks into actually application in terms of making a trading decision. Okay, but that is something that we will plan for. I can't tell you exactly when we are going to do that or if we are going to do that. So I will think about it, and maybe we will conduct a webinar on candlesticks in time to come. All right. So, okay, time is running out, and I hope that you managed to benefit. And as a conclusion, I just really want to emphasize again, if you are really very passionate and you think that trading is something that you want to work on because you want to be a profitable and proficient trader in time to come, risk management is one of the most important things that you need to learn and start with. Okay. So my suggestion usually for new traders is that forget about making money first. When you start to learn to trade, focus on how to make bets while containing your potential losses. Okay, focus on risk management until you become a very expert on risk management first. Then you go on to spend your effort on trying to see how to optimize and maximize the returns that you make from your profitable trade. All right, so I hope today's risk management gives you a good introduction to how to size your trade and why it's so important to understand risk management and manage your risk accordingly. All right, so I look forward to you joining me in the next webinar on the 1st of February. And at that point in time, I hope to be able to interact with you more and answer more of your questions over there. All right, so thanks for joining today's webinar, and I wish you a very good night and good luck trading in the year 2018. All right, see you. Bye.